So to your question, yes, this will be recorded. All right. Brandy, are you smoking a cigar? If you're smoking a cigar, tell me what brand cigar you're smoking. All right. So here's what we're going to go over today. April 30th trading mastermind call. How to identify which direction the market is going intraday. And by the way, this stuff is all sourced from you guys. These are all common questions that I get in the academy, as well as commentary on social media. But how to identify which direction the market is going intraday? Because I think this is, without this, it's going to be hard for you to determine what trade to take, right? Like before you take a day trade, you have to know which direction you're going to take the day trade in. I'm going to review my favorite strategy. Now, we did this on the last mastermind call, which was 2 weeks ago. But I get questions about this every single day. And I also got questions about going over it once again, just so that it sets in. So we're going to go over what is my favorite top tier A+ strategy, mental tips. The one question that I get over and over again that I think is hard for me to answer in a short form format, right? I always get asked a general question, give me some mental tips, or what are some mental tips that has helped you. And so I actually have a few slides on this that I put together today, because again, it's really hard off the cuff when someone's asking you for mental tips without really going into some more context as to what are some of the roadblocks that us as humans and our human minds prevent us from trading in an optimal way. So we have actually 3 or 4 slides on this specific topic today that I think is not talked about as much, because people tend to focus more on strategy and whatnot, but is equally as important as anything else, because honestly, it's even more important. I said this before, and we will go over this today, but strategy is not as important as execution. If you had a strategy, like say that all you did was trade moving average crossovers, and that's all you did, and moving average crossovers gives you a 50-50 result, meaning half of your trades lose, half of your trades win, you can be a profitable trader with proper execution and proper risk management, right? And that does not come about without knowing and identifying whether you are currently trading emotionally, or whether you are trading robotically and optimally, right? So this is going to be something that we actually have not dove into in detail on previous masterminds. And, hopefully you guys get something out of that. How to invest in treasuries. Another question I get, especially now that people are looking at treasury yields that, are basically paying more than they have been in the last 20 to 40 years, depending on which treasury you're looking at. And now that inflation is coming down, but is still kind of high, a lot of folks want to know how to invest in high yield instruments that are risk-free, right? Because you might see XYZ bank offer you a 4% yield or a 5% yield, but that is definitely not risk-free. And especially if you start talking about higher dollar amounts, you're only, covered by what the FDIC allows. So treasuries are considered the most risk-free investment, not in the United States, in the entire world. So we are going to get into how to invest in treasuries and roughly how to build a bond ladder. And then Q&A, I try to answer all of your questions. So let us jump right into it. Anything that, actually, you know what? I'll take your questions in the Q&A, but if while I'm talking, you think of a question that pertains to what I'm talking about, write it in the chat and I will try to get to it in the Q&A. All right. Cool. We got a ton of people on the call. Let's get started. So how to identify which direction the market is going intraday? This is known as a bias, right? A high time frame bias, or a directional bias for the day. So when you are day trading, you are obviously not taking trades off of a higher time frame. By higher time frame, I really mean anything above the 15-minute. Okay. And refer back, if you're part of the academy, refer back to 2 masterminds ago where we went over specifically which time frame to use, because that is another question that I get a lot. I'm not going to jump into it in detail here, but 15-minute and above is considered your high time frame. So as I said before, the market on a daily basis is just a series of liquidity grabs, right? If you notice, really take any single day in the market, and right now I'm looking at the NASDAQ, but you take any single day and it's just a series of liquidity from one side to the next. Now, it doesn't mean that it's going to jump to an exact level on the buy side. It's going to jump to an exact level on the sell side. But every single day, if you look at it, what makes price move, it is really just a series of liquidity grabs, right? To varying degrees. So on this day, you have a liquidity grab here, you have one here, it jumps back to the top. Like, what makes the price jump up and down each day, right? So as long as you know that it's just a series of liquidity grabs, that is going to help you a lot in determining what direction you're going to take. Now, what I do is when I start out the day, I will look at, the 1 hour and above and see, for instance, if there is any sign of being bullish or bearish in a biased manner, right? So if we look at the NASDAQ, for instance, and you see that this was Thursday's price action, obviously this looks bullish as hell. Now, is there anything telling me that there is a sign of reversal for Friday's price action? And looking at this, there isn't anything that would tell you that. Even if you were to draw patterns on the higher time frames, for those of you that have been around charting for a while, I'm sure you guys see that this is a bull flag. This is actually bullish. This is not bearish. So I will look at the higher time frames, 1 hour and up, to see if I can draw any sort of patterns long term. Now, I don't really draw patterns when I'm day trading. So when I start looking at the 5-minute and below, I'm not looking at bull flags and bear flags and whatnot. And we will talk about this when we talk about my favorite strategy or what makes an A+ setup. But I'm not looking, when I'm looking at the 5-minute and below, I'm not looking at bull flags and bear flags and whatnot. But I am looking at that when I start drawing out my higher time frame bias. I think that patterns are, from my experience, much better suited on higher time frames, right? They're not helpful for lower time frames. They just aren't. Because, as I said before, on the lower time frames, intraday, the market is just a series of liquidity grabs. How that formulates and manifests itself on the higher time frame is what's important to know, right? From a bias standpoint. So we have a bull flag on Thursday's price action. We had this huge run up and we have a bull flag. So obviously my bias going into Friday is going to be bullish. Now, I want to make this very clear. Just because your higher time frame is bullish doesn't mean that all of your intraday trades are going to be bullish. So a lot of traders are into scalping meaning jumping in for quicker moves. And you could certainly have bearish scalps because, again, the market is just on any given day, it's just a series of taking liquidity from both sides, right? So you certainly can have bearish scalps or bearish day trades on a bullish on a bullish day that you derived or concluded that from a higher time frame. Okay. It doesn't mean that every trade has to be bullish. It just means that you have to keep in mind that, hey, on the higher time frame, I spotted it looked ultra bullish. So be careful when trying to look for reversals, okay? Because there's no sign yet that there are any reversals. And I think that is one of the biggest mistakes that humans, especially beginner traders, but even experienced traders, even myself, right? I've been in the markets for almost 2 decades, been trading seriously since 2010. Day trading seriously since 2010. Even me, I have to fight the human urge to look for reversals. When I see bullish days like this, I'm like, oh man, should I be looking for a short? If I catch a short from the top, it's going to be epic and I'm going to be a hero to myself. And, I'm going to see my bank account exponentially multiply because I took the short from the ultimate top. But that is not the right way to look at things. Moore's law is trading against the trend than trading with the trend, right? So until you see a confirmed signal that the market wants to go lower, do not try and fight the trend. Again, it doesn't mean you can't take bearish scalps on a bullish day. It just means that most likely you are not going to find a larger bearish trade, right? Now, what would invalidate this is if we break market structure on the higher time frame. So on the 1 hour and up, if we break, if we start breaking down market structure, then I will say, okay, the market is potentially looking at reversing. This looks like a liquidity grab on the buy side or on the high side. And now I'm actually going to be looking for reversals. But until I get that, for me, the market is still bullish on the higher time frame, right? So then when I'm looking at the lower time frames now on Friday, let me just remove these drawings. I am, if I'm looking for bigger trades, again, I could trade bearish scalps, but when I'm looking for bigger trades, I'm still looking for bullish trades. So here's an example, and I'll dive into this when I jump into trading strategy. So don't worry about getting lost. I will explain this. But on this day, in the beginning of Friday on the NASDAQ, right, we have this liquidity grab here. And so once you see a liquidity grab here, and then the market starts going down, breaks market structure, and retraces back up, you have almost an A+ setup for taking, in this case, taking a bearish trade. Again, this would be very quick. I would take a bearish trade and look for to exit at previous lows, right? This is just a scalp here. I'm not looking for an ultimate reversal because, again, on the higher time frame, I'm still bullish. But this is just to give you an example that you could still take a bearish trade. It doesn't mean you cannot look for bearish trades if the opportunity presents itself. It just means that more likely than not, on most days where you see very bullish action on a higher time frame, you will not get that epic reverse. Now, you could get lucky and get in, you could get lucky and say you shorted from here and it ended up being a reversal day and you ended up shorting on a reversal day. That can happen. But when we'll talk about this more when we get into mental tips and psychology. You cannot celebrate luck as, let's say, as sincerely as you celebrate your wins based off of proper execution. Okay. We all get lucky in trading, and we all feel good about it, but it can completely jade your, I guess, your performance metrics that you are keeping yourself, right? It can completely dilute it because you got lucky, and it could have even been a lucky trade where you made more money than your entire life. But you have to identify that it was lucky and you weren't really executing properly on your strategy. Okay. And more often than not, by the way, those will be losing trades, but you could get lucky on a given day. All right. So on the 5 minute, again, you can take bearish trades on a bullish day. But as I said, looking at Thursday's price action on the higher time frame, it looks bullish, right? So when you see this, and again, I will go into this when I describe the strategy in a second, but you have liquidity grab here, and you have a liquidity grab here, right? So now after the market grabs liquidity here, what does it want to do? The market wants to now and especially when combined with your high time frame bullish bias, the market wants to climb, right? Now, if you were a supply and demand trader, and by the way, those of you who are familiar with me know that I don't argue with any strategy that you are able to execute upon profitably, right? I don't have a specific strategy for you that I'm so tied to that I would tell you, don't trade any other strategies but this one. I don't care. If someone comes to me and says, hey, I've been profitable trading only moving average crossovers, and my execution is so good that I'm actually a profitable trader, I will clap for that person. Okay. So if you were a supply and demand trader and you said to yourself, you know, we have a bullish bias on the higher time frame, we clearly have you know, a demand zone here just based on, again, based on previous lows. I'm just going to long from here, and I'm going to set my stop limit, you know, below the lowest wick here, so that I don't get stopped out. And that's going to be it, right? I'm just going to long from here, and I'm going to take profit at, you know, my ultimate profit target will be this previous high here. If you did that, great, more power to you. Is that how I trade? No. And there's a reason for this. Especially now after 2020, right? The market is acting in a way that I think the intraday volatility is crazy, where people's stops are getting taken out very easily. So for me, right? For me, again, if you trade differently, more power to you, but hopefully you get something out of this. For me, what I like to wait for is a confirmed liquidity grab, confirmed market structure break, and then I will trade the retracement, because the market has given me these free signals, and they're free because I've waited for them. I haven't committed any money yet, right? I'm just watching, but these are free signals that the market is giving me because I haven't committed to it. So I shared this before. Make sure you screenshot this so that you can refer to it later. But this to me is what qualifies an A+ setup. Okay, identifying liquidity, and I will jump into these things in detail. Lee says, do you trade off the 5-minute chart? Lee, I'm going over this in way more detail than the question that you're asking. So if you've missed it, you'll be able to rewind the tape. But identifying liquidity, is it a trending day or range bound day? Obviously, we've identified that it is a trending day. What is my daily bias? We've identified that, you know, on Thursday, the price action looked bullish. We expect that to continue on Friday until there is a signal change, right? Market structure shift, I will go into this. This I'm talking about intraday, right? So we had bearish market structure going down to this area of liquidity here. And now we have a market structure shift, and I'm looking to trade the retracement into a point of interest. So this could be Fibonacci. This could be a key level that you draw just by, you know, drawing horizontal lines at key levels. Some of you are into that. I'm into that as well. I like to be aware of what, you know, identifying whether a certain level represents a key area. Fair value gap, which is something that I've adopted into my trading as well, and I will explain what that is. Moving average, something that I don't really use, but I don't begrudge people who are profitable from using them. Okay. And then my risk to reward has to be 2-to-1 or better. So this, I think not enough people do, which is when they enter a trade, they are not taking this tool out and looking at what their target is and what their stop limit is, and whether that determines what is the risk to reward on that trade. Oh shit, sorry. What is the RR on that trade, right? And I will talk about this specific trade in a second. But if you took this trade here, what would be your stop limit? What would be your target? And what is your risk to reward? In this case, it's 5.88 to 1, meaning for every dollar that I risk, I'm making almost $6. This is a perfect setup. And I don't take trades that are generally less than 2-to-1. So my minimum is at least a 2-to-1 trade. But I don't think enough people do this. Like, how many of you, and be honest on the call, right? And this is a no judgment zone, right? This is strictly for all of us, including myself, to learn. How many of you honestly pull this up on every single trade, right? I know that those of you that are in the academy definitely do. A lot of you do, and some of you don't. But those of you that are joining us from outside of the academy, I know a lot of you probably don't do this, right? On every trade, you have this predefined. A lot of people enter a trade and then try to justify it to themselves later. And then in the trade, they're, they might see the thing bleeding, their position bleeding, and they're like, oh shit, I'm down 20%, 30% or whatever. Do I set a stop limit? Where do I set it at? I'm afraid to set a stop limit because if I get stopped out and then it goes my way, I'm going to, throw my monitor into the river out of anger. So, if you don't, I'm just going to tell you right now, if you don't have this up on every trade, stop trading. Just stop trading until you can force yourself to pull this tool up. And I'm using TradingView here. It's free. You have no excuse not to use it, but I don't care what you use. Even if you use the charting platform on your broker, right? If you don't have a sense for where's your stop limit, where's your target, and what RR does that risk reward, does that represent, do not take the trade. Just don't trade at all. Okay. Can you show RR on TOS? No. Now, TOS is Thinkorswim for those of you that don't use it. It's the TD Ameritrade platform. In my view, the most superior trading platform there is, although ugly as hell, I will admit. But there might be, if you Google this, Kenneth, if you Google this, people do create custom scripts for Thinkorswim, and I'm sure that someone has created a custom script for a RR tool in Thinkorswim, and you can import that and use it, right? Otherwise, you will have to calculate it manually, and that's fine. But as long as you know it, okay? Use TradingView for charting and TOS for execution. Yes, exactly, David. Yep, exactly. So again, let's look at this as an example. If you were a supply and demand trader and you just long from here, I would not begrudge you. I personally have been stopped out way too many times based on liquidity grabs, and I would much rather take the free signals that the market is giving me. And again, they're free because I haven't committed money to it yet. Okay. So market structure. Market structure, let me draw it out for you in very simple terms, okay? And this, again, this is recorded. And even if you guys are not part of the academy, you, I think we'll get emailed the recording afterwards. I'll have to check with my team. I apologize about the exact logistics, but refer to the recording if and when you see it, okay? So when we see bearish price action, it is just a series of higher highs and higher lows, okay? This is how it goes. A market structure shift is when we finally get a liquidity grab on the demand side, right? We want to see the previous lower high broken. So once, say, we take liquidity down here and the price spent some time down here, and then we see that the market potentially wants to reverse, how do we know that the reversal is true and accurate? We're not just taking the first sign of a reversal, because plenty of times, and you guys know this, if you do this prematurely, the market can just go back down and create a new low. And you took a long unnecessarily. So you want to see it pierce and close above this lower high, okay? Now, once we have this right here is your market structure shift. And now we are looking for what? We're looking for longs, right? So we had the liquidity grab up here. We had the liquidity grab here. And now we have a potential reversal that actually indicated a market structure shift. Now we want to trade the retracement. This is a free signal. This is a free signal. Now we want to trade the retracement. So we are going to take a trade from somewhere here, and I will describe to you what criteria I use to determine what that somewhere is, okay? But we are looking for longs here. Now, this is going to be the same for the long side, right? Say market structure is bullish. It's just a series of higher highs and higher lows, right? How do we determine where is the market structure shift from here? We determine where is the market structure shift because once we grab liquidity and the price wants to reverse, right? It's going to reverse below. We want to see a reversal below a previous higher low. So in this case, here's our higher low, the most recent one. We don't have a market structure shift until this is broken, right? Now, what are we going to do? We're going to wait for a retracement back up into a area of retracement or area of interest. And again, I will show you in a second how I determine that. And now what do we want to do? We want to take the trade from here. So you can try and short every single supply zone. You can try and short and long every single demand zone, but you will likely, more often than not, get stopped out quite a bit because of the liquidity grab could still be going and the market hasn't indicated to you yet that it's ready to reverse. So in my view, you're better off waiting for these free signals. So again, identifying liquidity, market structure shift. Now I'm going to talk about retracement. How do we identify these points of interest? Okay. And I'm going to show you here a real life example. Okay. So if you look at the NASDAQ here, we have a lower low, lower high, lower low, and now the market did grab liquidity and it wants to reverse, right? What am I looking for here? I'm in general looking for this to be broken, right? Now, some people might consider this. Some people might consider this right here the lower high that was broken, and they might take a trade way earlier than this, and that's fine to me, right? There is some form of subjectivity with market structure, not always, but sometimes. But even if you took a trade from down here, like if you waited for this to break and then you took this trade here and you went long, that's even better, right? But don't let perfect be the enemy of good. As long as you're abiding by these principles, and after you determine your trade, your RR is better than 2-to-1, you want to take that trade each and every time, and you want to hold it until it either executes for profit or executes your stop loss. You don't want to, and we'll get into this when we talk about psychology, but you don't want to quickly take profits on any sign of green, and if it's red, just let it bleed into perpetuity, right? All right, I've been talking a lot, and I realize that we do have a lot of questions. So let me get to some of these questions. Does this strategy work on higher time frames? You're not. That's kind of a moot question, David, because you're not going to be day trading off higher time frames. Now, if you're talking about swing trading, in general, it does follow. The market will follow these patterns of liquidity grabs, retracements into areas of interest and stuff. But in general, this is a day trading principle. This is not a swing trading principle. So if I was to answer your question with a yes or no, no, it doesn't apply one-to-one on higher time frames. And you definitely don't want to day trade off of anything. Again, we look for high time frame bias on 15 minutes and above, but you don't want to be taking trades off 15 minutes and above because those candles are too slow. So 5 minute, 3 minute, 2 minute, 1 minute. And again, refer to 2 lessons ago, I went in detail over which time frame to use. Wow, so many questions. I try to answer every question, so I want to see if there's any common ones. What is considered a liquidity grab? Okay, so multiple of those questions. How do you identify a confirmed signal? I already went over this. You must have asked this before I went over market structure. Another question about liquidity grab. Can you explain both futures or Tesla stock red or green days? No idea what that means. Apologies. Can you explain both futures or Tesla stock red or green days? Apologies. Gashi, you will have to reframe that question. I have no idea what that means. How do you exactly know where liquidity? Okay, so about 7 or 8 questions is about liquidity, so I will go over that. All right. Not gonna lie, I just recently started doing this. Oh, you're talking about the RR tool? I mean, again, this is a no judgment zone. This is for you to hopefully watch this and then on Monday start implementing new and more optimal tactics. Okay, cool. Long position, short position on TradingView. Yes. Oh, people were asking what tool it is. Okay, I'll show you what it is on TradingView. Cool. All right. So liquidity grabs. Are you going to cover purchasing bonds on TD Ameritrade today? Yes. Right here. How to invest in treasuries. Yes, I will cover that. Don't worry. Don't you worry. I got you. All right. So liquidity grab is actually very easy to identify. Okay. If you know how to draw a horizontal line and you know how to look at market tops and market bottoms, based on swing highs and swing lows, you can identify a liquidity grab. So on this day, for instance, you have a bunch of candles here forming resistance or supply or whatever you want to call it. You have one up here too, right? And you also have this. So I would use different colors for different lines, right? Like some lines are would determine liquidity grabs, some would determine potential liquidity grabs, some would determine key levels. Sometimes there's an overlap as to what that is, but I will have these drawn out, okay, and extend them. So once we come here on Friday, again, this is the NASDAQ, and we're going to stay on this just for simplicity. You know that this is a previous high. Once you see, and liquidity grabs, by the way, sometimes you will have equal highs, meaning that the liquidity will stop right at this high before going the other way. Most times it happens above the line. Now, why is that? Because supply and demand traders, support resistance traders, they are trading based off of textbook lines, which central banks, market makers, institutions, whatever, algorithms, there isn't one boogeyman. They're all executing orders based on the chart, right? There's multiple boogeymen. So they all know that supply and demand traders, support resistance traders will likely be shorting here, right? Because they learned from a textbook that this is a resistance line, and will have their stop limits where? Here, right? This is why I say wait for the free signal. It doesn't cost you anything to wait. So when you see price action go above this, and especially when you start seeing on the lower time frames, wicks on candles, you're basically going to have wicks on every candle. Usually, but not always, usually liquidity grabs will show themselves as having huge wicks too, right? So when you see these huge wicks into areas of liquidity, that is one of the clues that you have a liquidity grab. But as you see here, it doesn't always happen. Okay. So it's important to know that it's not going to always pop above that resistance line, and it's not going to always present you with enormous wicks. Most times, yes, not always. Okay. There is no always in trading. There isn't something that happens perfectly every time. Okay. But this is a clue. We have resistance here. We pop above. However, we're waiting for the free signal, right? You want to see a previous higher low taken out before entering a short, right? Now, most retail traders will enter a short here. Their stop limit is here. Obviously, institutions love that because your stop limit is their liquidity. This is why we call this buy side liquidity, because all of the stops, if you're shorting, if retail is shorting this white line, all of, to short, you have to sell to open. To close it out, in this case, your stop limit, you have to buy to close. So all of these orders are buy orders by retail, and you are essentially providing liquidity to institutions who are all selling up here because they want to short too. But if everybody wants to short from this white line, retail and institutions alike, there is no liquidity. If everyone is doing sell to open orders, who's buying, right? There is no liquidity there. So institutions need large buy orders in order for them to open their sell orders or their short orders, right? So they do this in the form of your stop limit. So they try to run the price up past resistance where they think there are a lot of buy orders in the form of stop limits, okay? So that's why we call this buy side, and then exact inverse on the sell side or the demand zone, right? So we see this is a sign that there's a potential, that this is a potential liquidity grab. And now the market, again, is just a series of liquidity grabs. It wants to now find liquidity on the other side, okay? Now, it could very well, by the way, obviously, we could do this and then, the market retrace a bit and then keep bouncing higher into these other potential areas of liquidity. There's nothing, there is no way for you to predict whether this is a liquidity grab besides the liquidity grab happening and then the market structure shift taking place and then a retracement back into an area of interest, okay? So after I see market structure break, that gives me a clue that this, as a matter of fact, now looking in hindsight, was a liquidity grab. Now I'm looking for shorts, okay? And same thing on the long side, right? We know that we have a previous liquidity grab here. And so when the price, let me just delete these. And so when the price starts coming back down here, I'm looking for a pop below this previous liquidity grab. And we get it in this form here. And we already went through what a market structure break looks like on this side. But we have we grab liquidity, we break market structure, retrace, etc. Right? But that is essentially what we're looking for. That is essentially a liquidity grab. Just look for a previous high or a previous low, and see if the market is ready to take liquidity, usually above that level. So in this case, once we get to this price action here, now we have a previous high here, right? We get to this level and we find that it's resistance multiple times. However, we see that the market eventually starts retracing into higher. If I draw this line out and extend it to the right, we see that eventually the market goes and grabs this liquidity that we drew a day before, right? And this is why you want to have these lines up on your chart. Now, obviously, Monday, it's yet to be seen what is going to happen. But this is actually good exercise for Monday. So we grab liquidity here, right? Now, say come Monday, as the NASDAQ starts trading again, what am I looking for? How do I determine whether this is a liquidity grab or the market wants to go higher? I'm looking for a market structure shift, right? I'm looking to see if market structure breaks. Now you will have different market structure breaks on different time frames. So looking at the 2 minute, it's going to look different. My market structure break would be here, right? A higher low. If we break below this, that's our market structure shift. If you're looking at the 5 minute, you're not going to get as granular of candles. So your market structure shift might be here, right? But essentially, you're looking for a market structure shift to determine whether this is actually a liquidity grab or the market wants to continue higher. All right. How much does volume indicate a market structure break? I don't look at volume. I don't look at volume at all. For me, price is king, because too many times you'll see the price move up on very weak volume and the price barely move on very strong volume. I don't look at volume at all. I look at impulsivity of the candle, right? So if we're getting a tiny wick above, above a market structure shift or below market structure shift, I might not really look to see if that is an actual market structure shift. If we get candles closing above and below, nice full-bodied impulsive candles, that to me is more of an indication that market structure is ready to shift. And by the way, I want you guys to look at something. This is actually very interesting here. We did pop above this area of liquidity here, right? And if I'm being honest, on Friday, if I see this, even though this is towards the end of the day, so I wouldn't be looking for a trade anyway, but just hypothetically, if I see this, I might think to myself, oh, this might be the liquidity grab that eventually takes us lower, right? But what would I be waiting for? So if I was a supply and demand trader, I might short this unsuccessfully because the market ended up going higher. I'm looking for a market structure shift, right? I'm looking for this to be broken and then a retracement, again, a free signal before taking a short, right? So this could have been a liquidity grab as we popped above a previous high or previous area of liquidity. And we popped above nicely and we started coming back down. So it could, if this was in real time, you could be saying to yourself, oh, we could be ready for a reversal here. But again, that's not what makes an A+ setup, right? Cool. On the buy side liquidity, institutions don't even need to guess right because they could see level 2. No. Stop limit orders are not on level 2. They are not anywhere. Okay. A stop limit order is hidden from the books. That is the purpose of a stop limit order. It's hidden from the books until a stop order, until the stop is hit and it becomes a limit order. Then the limit order is on the books. But if it's a stop limit order and the stop price hasn't been hit, it's not on the books. Okay. Because the broker doesn't even put it on the books or execute it until the stop price is hit. So that is a misconception. Does the speed of the candles mean anything? No. How about a market order? Well, yeah, but a market order executes immediately. So it doesn't even have time to get on the books before it executes. It executes literally immediately. Appreciate you. Thanks for explaining. Rushikesh says, thanks for explaining. Thank you, man. Taking out the previous lows confirm the reversal. I went over this in detail, Lumin. Refer back to the recording, not just previous lows. It has to break market structure. How many DTE do you choose when you buy and call and put options contract off the 5-minute? Well, if you're trading stock or options on equities, there is no DTE. It's either the end of this week or, future weeks. But I always trade the soonest expiring option if I'm trading equities, options on equities, right? Do you consider Bookmap? No, I don't even look at Bookmap. I think it's a waste of money and a waste of time. I have been studying price action concepts recently. It is very similar to a strategy. Would you consider yourself a price action trader? Yes, very much so, because price is the most important. It's the most important aspect of the chart. It's the only constant, right? It's the only thing that's set in stone. Volume is not set in stone, meaning yes, volume does happen and it does print, but again, price can move extremely on low volume, and it can move subtly on high volume. To me, there's too much divergence between volume and price, right? So like this whole move here, how would I capture this whole move here if I was looking at volume? Like, look at volume. It's not indicative of anything.
tot mai are pe primul loc.
Sorry, I don't know if someone was trying to talk, whether purposefully or not. I'm not sure what was said. All right. So the reason that I think Bookmap is a waste of money is this. L2 or level 2, right, is so easy to manipulate. It's so easy to manipulate L2 because you have what are called spooled orders, right? Spooled or phantom orders or ghost orders. An institution can place a huge order, a huge limit order, so that it appears on the books. And
mai sunt vreo 10-15 baloane.
Let me just mute this person. Guys, if you are not talking, please put yourself on mute. All right. I think him and his wife were having a discussion about institutional orders. All right. So Bookmap, you can easily manipulate or spool the orders, meaning if you're an institution, you can put a large amount of orders on the books, right? And then remove them. And people who use Bookmap see this all the time. And so, they fake you out into thinking, oh shit, there are a lot of orders here. Look at the Bookmap bubbles or whatever. And then those orders disappear. To me, it's so useless, right? It's a great marketing tool. They made a lot of money, but for me, it's useless. Again, if you are profitable, do not let me talk you out of your profitable strategy, okay? If you are profitable, by all means, do whatever you're doing. Don't listen to me. Yes, Sensei, do listen to me, but don't change up your strategy. Take what you find valuable from this and apply it, right? I did put everyone on mute. Perpetual says, love your respect for other trading styles. Yeah, man, I've been around the markets too long and have seen, a lot of people trade in different ways. And so many people, especially now with the advent of FinTwit and, social media trading, people talking down to other traders about their strategy saying, oh, I only trade ICT and you're an idiot if you trade retail. If you use moving averages, you're a retail trader and you're dumb. Guys, trading, just like sports, is objective. Are you making money? Yes or no? If not, there's probably a wide array of things you need to change. If you are making money, everybody needs to shut the fuck up. You're making money. Last question of options flow, how to use that. I don't trade off of options flow. I do look at it really as just an interesting metric, but you cannot trade merely off of options flow. You were talking to Benzinga that used 30 minutes if it is green or red day. Apologies once again, Gashi. I'm not entirely sure what you're referring to. Do you swing trade at all? Depends on the market environment. I'm going to get to your questions in Q&A. So let me move along in the lesson because I do want to cover all of this stuff. And we have a lot to cover.
Question, please?
But
hello, Z. Do you mind if I ask a quick question going back to that chart that you just took off the screen?
Yeah. What's up?
So on Monday, when the market opens, are you gonna use the lines starting from 10 a.m. Where the liquidity grab is? Is that where you're gonna start drawing your lines, or are you gonna refer back to the previous day or the previous week completely?
Okay, so that's a good question. I went over it in previous lessons, but I'll have multiple levels drawn out on the chart, right? So say that this is Monday. What am I doing? I'm drawing obviously this area of liquidity, and for speed's sake, I'm not going to be changing up the dotted lines and the colors of the lines and whatever. I'm gonna, just do it for speed's sake and show you what key levels I'm looking at, right? This obviously is an area of interest here. We've had resistance here a lot, right? I wouldn't count this as liquidity anymore because now we have this high, but this is an area of interest here. Obviously, you want to draw your bottom areas of potential liquidity. You have this swing low here, which would also be your market structure break on this time frame. Excuse me. And then you have potential areas of liquidity, right? You have this area of liquidity. Now, I might not draw every single line because I'm looking at this and visually I can tell what is an area of liquidity, but this is just for demonstration's sake, right? You have this area of potential liquidity, and then you have ultimate, this area here, right? So the ultimate, if this was Monday, would be that this was a liquidity grab, and we have a market structure break, a retracement into an area of interest, which I still need to talk about. And then take a short from there. And the ultimate would be if we can grab, if it is going to be a short day, a bearish day, if we can grab that trade and ride it all the way down. Obviously, if you're trading multiple contracts, you will be having take profits along the way. You cannot just hold one contract and hope to hit glory, right? If you only were trading one contract, which is perfectly fine, don't let anybody talk you out of or talk you up in size, right? You would set more reasonable profit targets. If you had multiple contracts, then you have more leverage. The more leverage you have, the more risk you can take, right? Makes sense. So that's what I would do. And then obviously I also have, even though Monday is going to be a new month, I usually have the monthly opening mapped out. I just go to the monthly chart and I'll have the monthly opening and the monthly close, for instance. And then same thing for the weekly, right? Now, also on the high time frame, I will draw out if we are close to high time frame areas of liquidity. You can see this here on the weekly chart. I will draw that out. And again, I use different colors based on my, based on what I've been doing for years. So if I see orange, I know what that means. If I see white, I know what that means. Develop a system that works for you. In the meantime, I will, like, if I was you, I would write out like weekly liquidity, right? I will write that out here. That way, when I go to the lower time frame charts, and I see that, if I see, if the price starts moving up and I see this, I know exactly what it is, right? 1 week liquidity once the price starts moving up there. So that's what I have out on the chart in terms of liquidity levels. And then obviously if the market starts, behaving bearishly and we get down into this territory, now you want to start looking back and seeing if there are, using the same exact exercise. Again, you're just drawing horizontal lines. Like, this is the beauty about day trading based off of price action. One, it's really simple in my view. And two, you don't have to draw freaking all kinds of patterns, right? Like, people that are just starting out with TA are like, what is a cup and handle and the head and shoulders and a bull flag and a bear flag? Again, that is helpful for high time frame. When I'm looking at high time frame, I'm like, oh shit, this is a bull flag. I will most likely be looking for bigger bullish trades because high time frame is bullish, right? Or you might get this double bottom here on the high time frame. You might look for potentially bullish reversals if we were back here. Same thing, for the bearish side on the high time frame. You might have seen this double top back here, and you might say to yourself, okay, this is a potential double top. I might look for a bearish reversal, etc. It's honestly, especially if you're practicing this stuff every day, it's really simple. It's not that hard. Execution is by far harder than strategy, by far. Because again, screenshot this, print it out, whatever. This is all you need. This is all you need. If you're having trouble with a strategy, this is all you need. Okay. Let me talk about this, and then I'll get to your questions. This is mental tips. Okay. Area of interest. So we talked about identifying liquidity, market structure shift. We talked about RR. In this case, area of interest, for me, I use, again, as I said, fair value gaps, Fibonacci, and, key levels, right? So in this case, we took liquidity here, took liquidity here. I talked about this potential bearish trade. Now that we took liquidity here, we broke market structure. I'm looking for bullish trades. So let's say that, this is a market structure that we were also monitoring. It broke this, and we are retracing down, and now I'm looking for bullish trades. If I'm trading fair value gaps, I have this fair value gap here, and I will explain this in a second. And then I also pull up my Fibonacci tool, right? So I have this swing low here. Again, I always draw them left to right. Refer back to last Mastermind or the one before, where I go over Fibonacci. I always draw it left to right. I have the swing low here, the swing high here. So I have confluence with the fair value gap. I have confluence with the Fibonacci. It hit right at the golden pocket, and we saw a bullish bounce. And if I was taking this trade, let me pull out my long tool, right? The long and short tool in TradingView. I usually take trades from at least half of the fair value gap. My stop limit is going to be below the fair value gap. And my take profit is going to be this, right? The previous high, which is a very viable and sensible target, right? So when I look at this trade is a 7.6 to 1 trade. Hell yeah, I'm taking this trade. Of course I'm taking this trade, right? And I will not take my foot off the gas prematurely. I just set it and I let it play out. And we'll talk about this when we talk about mentality, but just having this long tool or short tool in TradingView, if you go to the left here, you'll see long position, short position. So if you were in a long position and you wanted to get your risk to reward defined, you would click that. Same for the short position. Okay. But yeah, this will go a long way in resolving one of the mental blocks that you will experience, which is, taking profit on green trades too quick, or letting red trades bleed too much, right? And by the way, I want you guys to know something. When I said 50, if you have a strategy that pays you 50-50, you can still be a profitable, or that yields a win 50% of the time, you can still be a profitable trader, because 2-to-1 RR, right? You only need to be profitable 33% of the time in order. You only need to win 33% of your trades in order for you to be profitable on 2-to-1, right? On 1-to-1, you need to be profitable more than 50% of the time. And the way that you come up with this, it's a quick formula. If you want to know how many trades you need to win in order to be profitable, you just take these two numbers and you add them up, and you go 1 divided by whatever that number is. And that will tell you how many trades you need to win in order to be profitable. In this case, it's 33%, right? So if you took only, let's say, if you took only 5-to-1 or 4-to-1 trades, right? let's say that your RR was 4-1 all the time. And I think this is a bit unrealistic, but just to give you an example, then you only need to win 20% of your trades to be profitable. So win rate is bullshit compared to profitability, right? So in this case, this is a 7.6 to 1 trade. You're not going to get this all the time, but when it presents itself, you have to take it. You have to take it. And by the way, I don't begrudge anyone that says, you know, this might be too optimistic. This take profit level here might be too optimistic or too ambitious for me. I want to stick to this area of profit taking, right? Like previous high. So if you drag your risk to reward tool down here, what would this trade be? If your stop loss is here, you take the trade here. If you drag this down, you're still dealing with a 4-1 trade. Okay. This is why this is imperative, because you will know whether you should take the trade or not. So even if your A+ setup is there and you pull out this profit tool and it shows that you're not at a 2-1 risk to reward, you shouldn't take the trade. That is the last step in determining whether you should take the trade. Okay. But even if this profit target was too ambitious for you, and you say to yourself, you know, I have set larger profit targets before and I routinely miss them. Well, okay, take the previous high, take a lower profit target, a less ambitious target. Even if you take this trade, you're still at 4-1 and you should take this trade. Okay. As long as you know, and there is no concept of taking profit early. There's a concept of taking profit at realistic levels. That's it. It could turn out to be too early. It could turn out to be just right. It doesn't matter. What matters is, did you set your take profit at a realistic target? And is it better than 2-1 RR? Because if you take a trade like this every single time, that's 4-1 RR, you only need to win 20% of your trades. You only need to win more than 2 out of 10 of every trade. So think about that.
Hi, Z.
Hey.
Aaron here. 2 questions. The R&R, right? Is that a dollar for dollar calculation? So for every dollar that it potentially can go down, you're looking at a $4 move up. Is that just, it's not, because it's not, if you're doing options, it'll be a greater reward, right? If the price moved up that much, 4-1.
That's a good question. I covered in detail options versus futures in the previous mastermind. So if you have access to that, refer to that. But I covered that in detail. But yes, in this case, we're dealing with NASDAQ futures. So it trades like an equity, right? Meaning that the price that you see is the price that it is. It's face value pricing. So this is calculating RR based off of the face value price of NASDAQ. If you're trading options, it's going to be a bit different because the price of the option is going to be so violent that and also it is not, you can't calculate it to the T the way that you can with futures. You don't really know exactly what is your risk to reward to the dollar amount the way that you would with futures. Now, again, I covered this in the last one, but with options, you want to set your stop limit still, like say you're looking at Tesla, you want to set a stop limit based on the price of the stock. You don't want to set a stop limit on the option. Never do you want to set a stop limit on the option. It's not optimal. You have no good idea for whether, if you set it at minus 20%, are you going to get stopped out prematurely, or are you going to get saved by your stop limit? You have no idea, because options, the way that they're priced, options are priced based on activity, right? So a lot of people think implied volatility is an input. Implied volatility is an output in the options pricing calculation. It's actually the last thing that's calculated if you're using the Black-Scholes model, which we're not going to go into. But and it's all based on whether there's traffic coming to that option or not. That's how options are priced. So when and I went through this in detail, by the way, on the last mastermind. So refer to that, because I go into a tutorial in Thinkorswim on how to set your exit and your take profit on options based on the stock price. So for instance, if I'm on Tesla here and I decided to, I don't know, take a long from this retracement, say that in this case, we have a fair value gap here. And I use the Fibonacci tool, and I'm drawing this out from the swing low to the swing high, and I take a long from here. I went over in Thinkorswim how to set a stop limit. Like say I took a call option here, how to set a stop limit based on Tesla's price. So I would set it if Tesla went below 159.65 in this case, the option would then get market sold, right? And I'm only dealing with liquid options. So the bid ask price is very narrow, and I don't care if I'm using market orders in that case. When you're dealing with illiquid options, you cannot risk using market orders because the bid ask is too wide. So my stop loss would be if Tesla is below 159.65, market sell the option. If Tesla hits a profit target of, I don't know, I'm not going to go back and look at Tesla, but if it hits a certain profit target of, let's just say 163, then market sell that for profit. But yes, it's not as straightforward with options. What is the best time frame? I went over this in detail 2 masterminds ago. So refer to that, but there is no best time frame. You're just trying to tell a story, and you're using time frame in order to help you contextualize that, right? And also rewind this mastermind, because I went to the high time frame to determine the bias, and then the lower time frame to take my trades off of. But say I was in Tesla here, and it's not, we have all these green candles, and it's not clear to me on the 5-minute whether there's a decent entry or not. Even though in this case we did have a nice, market structure break, and then we had a retracement, you could take that long. But if I need more context on these candles, because they're just big green 5-minute candles, I could switch to the 1 minute. I could switch to the 1 minute to see if there is, if there is a little bit more context here, or the 2 minute to see if there's a little bit more context here. There isn't a magic time frame. You are, trading. You are trying to tell a story based off the time frames, and if you cannot see it on the 5-minute and you need more data, then you switch to the 3-minute. If you can't see it on the 3-minute, switch to the 2-minute, etc. But I only switch time frames if say I'll start on the 5-minute to take my trades, and I'll only start scaling down if I can't see anything, or if I need more candles to make the picture clearer for me, right? So hopefully that makes sense. Karen, is there a way to get access to the previous masterminds? Yes, there's a way to get access to the previous masterminds. They are literally all in the mastermind recording channel in the academy. You can literally click on any one and rewatch it. So you need access to the academy. You should get an email for a discount after this call. But yeah, you will need access to the academy. They aren't just available for free online, or else I wouldn't be providing a value to academy members. So we went over that. Okay, it's time for mental tips, and then I'm going to get into how to invest in treasuries. Okay. But yeah, hopefully you guys can screenshot this. And refer to it later. All right. Would really appreciate if you could do a separate call for executing regular trades. How do you execute this? Long at 10.75 on ES. I have a whole free video on how to trade futures. So just go to how to trade futures on YouTube, the traveling trader. But what you're referring to looks like an abbreviation of price. So on ES futures, people think they're being cool by omitting the first two numbers, but 10.75 usually is referring to 41.1075, right? So like in this case, ES is now 41.9075. People will usually type 90.75 as an abbreviation just to get the trade alert out. But futures are straightforward. You're either buying them or selling them. They're not like options where you can formulate so many different strategies and iron condors and multi-leg strategies and butterflies and whatnot, vertical spreads. You can either just buy a future or just sell a future. That's it. It's just like an equity, right? You can buy to open, sell to close, sell to open, which is a short, buy to close. That's it. Would waiting for the retest keep you from getting caught in a liquidity trap? Not sure what you mean by liquidity trap, but yes. Is there a major difference between using 7, 8, or 9 EMA with the 21 crossover? Use what works for you, but between 8 and 9, no. It's just a matter of, I don't know, whatever you were taught or preference. There isn't really a difference. All right. If there's any other questions on trading strategy and any questions on this, can I trade futures on Robinhood? No. And you shouldn't be trading on Robinhood if you want to take trading seriously. 100% honest. Robinhood is a Mickey Mouse platform. Will we be getting a recording of today's mastermind? Yes. What's the link to the academy, please? I would say if you want to join the academy, Perpetual, refer to the link in your email because you will get a discount if you're on this call, right? So if you're on this call, you will get a discount. I could send you the link to the academy, but I want you to get a discount. If you want to just join the academy, you can always go to thetravelingtrader.com and join from there. Pretty easy, but I want you to get the discount. So refer to your email. And if you don't see the discount in your email, then email subscriptions@thetravelingtrader.com, right? All right. If there's any question on trading strategy, let me know. We're going to jump into mental tips and then how to trade or invest in treasuries. Okay.
Can I interject? This is Franklin again. I have a question. Can you talk about? I've seen you use the VWAP sometimes on your while day trading. Could you just talk about that?
I'll do it in the Q&A. I won't do it now. But yes, I will log that question for Q&A. And I don't trade off of VWAP, by the way. So just a spoiler there. I have VWAP up because it usually does act as a magnet for price, but I don't execute trades off of VWAP. I just want to be aware of where it's at because price will usually, if it's getting close to VWAP, will magnet around there for some time. David, what indicators are you mostly using? Barely any. And rewind the take was I go over my strategy now for an hour and 20 minutes. So, all right, mental tips. So this is one of the most commonly asked questions that I get. Can you give me some tips on psychology? Can you give me mental tips? Can you help me with trading psychology? I'm having a lot of trouble with my mentality, with my psychology when entering trades. Okay. I thought about this really in detail last night, and I put together these slides because I try to distill it into something that you can digest and readily apply. Okay. So I'm going to go over common issues with trading psychology, trading mentality, and hopefully and try to bucket all of the issues that I see with trading mentality into high level categories And I call this the three-headed dragon, okay, of mental blocks. Trading, I should market this better, really. Mental blocks, I mean, that's, I'll figure something out. But let's call it the three-headed dragon. I think was good. Mental blocks needs a little work. Okay. So fear, greed, and anger. And by the way, there's nothing that I can show you here that will help you with mentality except for to revisit this. And when you are trading, to be aware of this and executing on this every single day. Exposure therapy is essentially what's going to help you in trading. Okay. You're not just going to read something and then be better, infinitely, exponentially better. You could be incrementally better, but you have to be hardened by the market. But the starting point is actually being aware of this first. So the three-headed dragon, fear, greed, and anger. All problems that I see with trading are bucketed into these three categories. All of them. So let's dive into each one. And then I'm going to go back to these bullet points. Okay. So fear. Here are some examples of bad behavior associated with fear. Closing green trades too quickly. Okay. And hopefully setting your risk to reward beforehand and trying to robotically adhere to that is going to help with this. But if any of these apply to something that you've done, it should alert you that you are doing something that is not based in trading and is based in one of these three categories. And it's a clue for you to stop it. Okay. You should be as robotic as possible with trading. Closing green trades too quickly. Why are you doing this? Well, because we are apes at the end of the day. And once we see that we have a stash, we're afraid to lose it. So if if you go back to the chart and you're looking, let's go back to NQ. Let's say that you enter this trade here and you see your profit and loss. It's green. It's $150 green. And you close it out without having any regard for what's going on in the chart. That is a sign that you need to stop that. And that is likely a sign that your position size is not yet comfortable for you. Okay? Because you are so scared of losing that you are likely not ready for that position size. In which case you could trade an instrument that moves less violently, right? In which case you wouldn't be afraid of losing and closing your green trades too quickly. Or you just need more time in the market, right? And in my view, like say you're trading ES futures, you should probably take it a notch down to micro ES futures, which are 1/10 the value of ES futures, okay? But closing green trades too quickly, afraid of locking in a loss, so you hold losers. Again, hopefully having this risk to reward will practically allow you to get over some of these mental imbalances as it relates to trading. But if you don't have this up and you have no idea when you're going to take a loss, once you are on the path to losing, right? Like, like say you shorted this level as we talked about previously, and the market just kept going up and you have no idea for when you're going to take a profit. In your mind, you're so afraid of locking in a loss because of a lot of things. One, because you're afraid that you're tricked into this stupid mentality that, you only lose if you sell or you only lose if you close your position, right? Which is stupid. Two, you get into this, you're afraid of how you will feel after locking in a loser, right? You will say to yourself, oh my God, I'm such a shitty trader. What does this say about me? Et cetera, et cetera, et cetera. That just means that you're not confident yet in your strategy and you are not confident in your profitability. Because remember, if you are only taking 4-to-1 RR trades, you only need to win 2 out of 10 trades to be profitable. That's it, right? So win rate should not matter to you. profitability should matter to you. So if you enter a short here, you would already have your RR set up, right? Let's just say that you were targeting this area here. I'm not saying you should have entered a short here. I'm just saying, what if you did? And your stop limit should be congruent with your RR, right? So if you had set a stop limit here, a take profit here, and you're doing this every single time based on A+ setups, then win rate doesn't freaking matter. It doesn't matter if you win 7 out of 10 trades, 6 out of 10 trades, 4 out of 10 trades. What matters is profitability, right? And that will help you, hopefully, combat this here, right? And then lastly, people are afraid of locking in a loss, or they hold losers because they have this sort of this perpetual hope that things will turn around, right? So you enter a short here, the market keeps going up, and in your mind, you're like, no, I hope this turns around. Now I'm just holding based out of hope, nothing else. I'm not holding based on logic. I'm not holding based on plan. I'm not holding based on objective numbers. I'm just holding based on hope. And once you get into that, you have to cut out of that trade and you have to reset yourself. Again, just knowing this will help if you can, along the trading day, if you can identify that you are falling victim to some of these things, will help you. But nothing beats screen time. Okay. AH says, appreciate all the great tips you've shared. Yeah, thank you. Number 2, greed, right? Here are some common behaviors or misbehaviors related to greed. You're influenced by social media, so you try to replicate it immediately. You might be on social media and you might see someone says, oh, 50K day or whatever. I made 10K every day this week or whatever. Guys, it's social media. One, right? People are showing you, there's so many tactics. Like, think of it logically. There's so many tactics that people use, such as you can have as many accounts as you want. Say you take a trade in your fucking TD Ameritrade account and it was risky as shit, right? And it doesn't work out for you, but you take another trade in your Webull account and it works out for you. That's the one that these people who are, usually trying to sell you something are showing you on social media. They're not showing you an accurate accounting of what they're doing on a day-to-day basis. They're not teaching you how to trade. They're flaunting a trade, either because it feels good to them to boast, or usually they're trying to sell you a dream, right? Trading is fucking hard. It's not easy. And it's hard because of execution. The actual strategy, the actual, identifying liquidity, market structure breakers, that stuff can be learned in a day. That's not that hard. Execution is by far the hardest. Once real money's in, your whole mind changes, right? So these are some forms or misbehaviors of greed. You're influenced by social media, so you try to replicate it immediately. Usually that means sizing up when you shouldn't be sizing up. The only time you should be sizing up is if you've proven profitability and now you say to yourself, I'm comfortable sizing up and I'm comfortable with the fluctuations that sizing up brings, okay? The profit and loss, I'm comfortable with that. It doesn't make me change my behavior. Going back to this, would you behave differently if your position was smaller? If the answer is yes, you were not ready to size up, okay? Setting unrealistic chart targets. I see this all the time, right? People want that banger of a trade. And so they say, I'm going to short, like say that you identified a short here at a supply level. And you say to yourself, I'm going to short here and I'm not going to take profit until we hit this level here. And by golly, I'm starting to calculate what that means in dollar figures. And, we are talking about almost a 200-point trade on the NASDAQ futures, which on one contract, that's $4,000. Oh my God, this is crazy. Like this is going to be my take profit. That's it, right? Ignoring the fact that you have a very viable and sensible take profit here. If you took this short, you have a very viable and sensible take profit here, right? This is an unrealistic target. If all you're doing is drawing a line at the extremes and saying that is my take profit, that is unrealistic. And that is usually a sign of greed, okay? Lawrence Zago says, the moment we enter a trade, we are under influence of chemical substances triggered by emotions. Exactly. If you want to look at it scientifically, for sure. And lastly, I'll talk about anger before I jump into treasuries. Anger, usually the first sign of anger has to do with revenge trading. The minute that you lose a trade, I want you guys to recognize something, right? And Lauren Zago mentioned something close to this, right? But the minute that you lose a trade, the minute that you lose that first trade, the probability of revenge rises, okay? The probability of revenge rises, meaning that whatever goes on in your mind, your first impulse as a human being, as an animal, your first impulse is to take it out on the market, is to revenge trade. If you are entering a trade based off this, stop it, okay? If you enter a trade and you lose and then you quickly hit the market buy or market sell order and you want to re-enter, not based on any objective metrics, just based on emotion, stop it. Anger, self-sabotaging, punishing yourself. This is an extreme that I've seen, that I've even fallen victim to, not only in trading, in other things in life too. But self-sabotaging or punishing yourself. This is a very complex and maybe a human trait evolutionarily that is not conducive to survival, okay? But you end up like losing or letting losing trades bleed as you see your profit and loss go down. You're not even doing this out of hope anymore. You're doing this out of anger. You're punishing yourself for something that you think you did wrongly, which is lose a trade, which is not wrong if you stuck to A+ setups, if you stuck to your profit and loss tool. If you lost the trade, you lost the freaking trade, but you did everything right. Again, if your RR is 4-1, you only need to win more than 2 out of every 10 of your trades. If it's 3-1, you need to win more than 25% of the time. That's it. And then sizing up out of anger. There's sizing up out of greed. There's also sizing up out of anger. So hopefully, identifying this, and you guys, I know that every single person on this call, including myself, has fallen victim to something out of these buckets. At least one. For me, I've fallen victim to all of these: fear, greed, anger. Okay. And continue, by the way, to be subject to them, but I'm not a slave to them. And the way that you get out of that is by recognizing it, and then by screen time, by facing them, by being exposed to them and combating them. Do not click, basically don't click the mouse button if you recognize that the reason that you're clicking them falls into these buckets. All right. And if it helps you, because this helps me, right? Mamba mentality, Kobe mentality, this helps me all the time. Trading is a zero-sum game. When you remember that when you start making mistakes and you fall victim to this stuff and you lose money because of these things that are unnecessary, that are incongruent with profitable trading, I want you to remember something. You are not trading against the monitor, right? You're not trading against your computer screen. Picture, just really vividly imagine somebody else enjoying your money on that day, right? When you start punishing yourself or falling victim to greed or, falling victim to fear, I want you to remember that somebody else has taken your money. You're trading against somebody else. You're not trading against TD Ameritrade. You're not trading against the computer screen. You're not trading against other members on the Discord. You're trading against somebody else that has now taken your money. They could fucking take their family out on a vacation with it, right? They can go buy a new car with it. They could buy a watch that they've been eyeing with it. They took your money. So if that's what you need to make sure that you don't fall victim to this shit, then use that, right? Use it as a competition, as you would, a boxing match or a basketball game or a match on the golf course, something that's ultra competitive. Picture trading in that same way, because I guarantee you, the minute that you picture somebody else enjoying your money, you will stop doing whatever it is that you are doing that is attacking your profitability. So hopefully that helps. And lastly, I talked about this before, but sign a contract with yourself. I want you to sign a contract with yourself saying you're only going to take A+ setups based on this or whatever your strategy is. You're not going to fall victim to this stuff. You are not going to press the buy or sell button unless your criteria is hit. You are going to map out every single trade. What is the risk to reward? Take that, type that up in Word, go to Kinko's or whatever, Staples, print 250 of them, because that's how many trading days there are in the year, and print a line for your signature and sign it and leave it on your desk. Like, leave it right here on your desk next to you every single day. Like, take one from the stack, sign it. Someone says lost sound. Really? Is it just Randy? Oh, okay. Yeah, it's just Randy. Sign it and leave it next to you on your desk. Okay. And I guarantee you these two things will change the fucking game for you. All right. Wow. Super packed mastermind. But they're all packed. They're all packed. Just go back and watch all of them. You'll see. They're, in my view, literally the most packed trading classes that one can take online. In my view, humble opinion. Hopefully you guys on the chat agree with that. Yeah, appreciate you, Clint and Aaron. How to invest in treasuries, and Erica and Yami, appreciate you guys. And Ale, thank you guys so much for the support. And Virendra, appreciate you. Mel, King Julian, how to invest in treasuries on TD Ameritrade. Okay. We are going to jump into this. How to invest in treasuries. Let me just log in real quick to my TD Ameritrade, because I will show you. I get this idea all the time. This question all the time. How to invest in treasuries, right? Let's go to, and I'm going to show you how to build a bond ladder. Now, this is going to be tough because the treasury market isn't open right now. All right. Let me share my screen again. Okay, you should be able to see my screen now. I get this question all the time. Now, the reason I get this question is because if you go to bond rates, you'll see what these yields are, and yields have been climbing once again because yields have started to climb based on two things. One, fear of the economy. Two, the fact that interest rates, the Fed is raising interest rates, right? And these are bond yields that on some of these bonds we haven't seen in 20 to 40 years, right? So for those of you that are around my age, you don't remember the last time you got these yields on bonds. Bonds were paying like less than 1%, some less than 0.5%. It's crazy that we're now seeing 4 or 5% on some bonds. So for a quick overview of bond yields, I would suggest going to CNBC or something. They release their bond yields every single day, and you'll get a sense for what the bond yields pay. Okay. Now there is a free way. There are free ways to buy bonds. I buy them on TD Ameritrade because a lot of my accounts are on TD Ameritrade. Okay, so it's easy for me. That's where my money is. It's easier for me to buy bonds, and they have a robust way of buying bonds. If you don't have a TD Ameritrade account, look up what it is for Fidelity or whatever it is that you are that you use. You can also go to treasurydirect.gov, open an account there. As long as you have a social security number, you can open an account with treasurydirect.gov. That is a government website, no fees to open up treasuries. So treasuries are the safest investment in the entire world. They are risk-free unless unless the US government defaults on the debt. Now, when you hear about defaulting on the debt, that's what they're referring to, is that the US government takes on debt by issuing treasuries and saying, I'm going to pay you more in the future. Okay. So the 1 month, these are the yields. Now, these yields are annualized, right? So the 1 month is paying 4.2, 2 month is paying 5, 3 months paying almost 5.1, 4 month 5.182, and so on and so forth. Right now, the 4 month is paying the most. Now, yields go up and down, not only based on interest rates and based on economic fears, but based on activity. So the more that treasury yields are being bought up, or treasuries are being bought up, the lower the yield is. So you can see, for instance, longer term yields are trading at much less than shorter term yields. This is what we mean by inverted yield curves. The reason that is because people are scared about inflation and scared about the economy. So they want to lock in a long-term rate, right? They are more hopeful about, or they are less hopeful, sorry, about the future. And so they want to lock in a long-term rate. And so many bond investors pour into long-term bonds that they ignore more or less the short-term ones. So the short-term ones, the more they are ignored, the higher the yield is. Okay. But this poses a good investment for those that are looking to make high yield on their accounts in the short term, or on their money in the short term, right? So here's the thing. You can obviously put your money in a bank, but a bank is only good for up to a certain insurance limit with FDIC. Now it's $250K. Most of the big banks won't offer you high yield. They will offer you some yield, but usually the smaller banks or the regional banks are offering more yield because they're struggling more. So they want you to put their money there. The only thing is, obviously, as we've been seeing with bank runs, they run the risk of being run on. And so that is, that is one of the reasons why I prefer putting my money in treasuries over putting my money in a high bearing interest account with a bank. And also there are tax benefits as well. So you can Google what that is for your state or your locale. That is why I do that. Okay. And then also, obviously, you could buy them for your tax advantaged accounts, IRAs, 401ks, or whatever. So either go to treasurydirect.gov or you could do this in TD Ameritrade. Now, I want you guys to know something. There are new issues, right? Every week we have bond auctions, and there are treasuries that are available on the market. So any treasury that you have, you can essentially sell that on the market. They are traded like stocks, like equities. So you could buy treasuries that are currently on the market, or you can invest in what are called new issues. Now, new issues will generally get yields that are close to this, right? However, you can buy treasuries on the open market that people or investors or institutions are selling, where you can get a decent yield on something that, like, say someone is putting their 10-year bond for sale on the open market, and there's 3 years left. So essentially you could buy a 10-year bond that has 3 years left, and in TD Ameritrade, as well as other platforms, it will tell you what the yield to maturity is, right? And it looks like this. So I can't show you, if I click on treasuries, nothing pops up because the treasury market is not open, but I took a screenshot for how it looks like. So here's what a treasury looks like on TD Ameritrade. The treasury market looks like on TD Ameritrade. The CUSIP is just an identifier, right? Order quantity available, right? So the minimum order quantity is the first number. The available quantity is the second number. Now, most treasuries have a face value of $1,000, okay? So most treasuries have a face value of $1,000. So one quantity usually equals $1,000. 5 equals $5,000, so on and so forth. Okay. Let's take the second one here, for instance. Okay. Coupon pay frequency. So anything that's over a 1-year treasury pays a coupon. Anything less than 1 year doesn't pay a coupon. You just get the face value back at maturity, right? And I'm going to go into that. But so if you buy, for instance, a 4-month treasury bill, you're not paid a coupon. You just buy it for less than $1,000, and you get $1,000 back after 4 months. And that usually that is how the yield is calculated, right? So if something has a 5% yield, for instance, just for simplicity's sake, you're buying it at $950, and you will get $1,000 back at maturity, right? Which is, in this case, would be 4 months. However, anything that's over a year, you're also getting a coupon. And here it tells you how it's paid. So in this case, this coupon pays 2.25%, and it's paid semi-annually. So not only do you get the face value of $1,000 back at maturity, right? And it tells you when it will mature. Here in this case is November 15th, 2025. So you will get 2.25% paid twice a year. So it would be 1.125 every 6 months. But the yield to maturity is 4.193. So the yield to maturity is calculated using it's a combination of the coupon as well as the price of that bond. So if you bought this bond here, it matures in November 15, 2025, and complete your coupon plus the face value that you get back at maturity, all of that will equal 4.193%. Okay. And in this case, you're buying it for $945.76 per treasury, and you're getting back $1,000 at maturity plus the coupon. Okay. But remember, anything less than a year doesn't pay a coupon. You just buy it for a discounted price, and the government pays you back $1,000 per bond at maturity. Okay. So you can buy treasuries on the open market. You would click US Treasuries, and it would pop up. You do this on Monday when the treasury market is open, and you would see all of the terms: 0 to 1 year, 1 to 3 year, 3 to 5 year, etc. And you would click on the ones that you want, and you see all of the treasuries on the open market, and it would look like this, right? And you'd be able to then click on them and buy them, right? You also have the option of new issues. So every week there is an auction, and you can type in how often or on what day is the 4-week treasury bill auction, right? And it's on Thursday. I happen to know that because that's what I continue to buy. You go here to trade, and you go to fixed income new issues. Okay. And under fixed income new issues, wait a minute. And I think I just revealed one of my accounts here, which doesn't matter. I don't care. Blah, 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 blah. Let me actually see where this is. Hold on. Research, bond and CD wizard. Where? I think because the market is not open. 1 second. Regular individual account. Okay, I got it. Let me share it again. Sorry. My bad. All right. So under research and ideas, you go to bond and CD wizard in TD Ameritrade. And by the way, you can't do this in Thinkorswim. You have to do this in TD Ameritrade. And you'd go to new issues. And you'd see here treasury auctions, right? Under treasury auctions, you want to click on view all, okay? Because it will show you literally all of the upcoming treasury bill auctions and treasury note auctions, okay? And again, this is for new issues, and you can look. There are easier ways than TD Ameritrade to look up bond yields. I like the CNBC site because it's up to date. But let's just say that you wanted to invest in, let's say, for 4 months, for 4 times 4 is 16, 3 times 4. Let's say you wanted to invest in a 3-month T-bill, right, at almost 5.1%, and you wanted to buy new issues, right? You would, and if the auction is not available yet, it won't show you a circle here, right? So it tells you what the auction date is, what the minimum quantity is. Remember, every one is equal to $1,000, and what the maximum quantity is, and it's $10,000, which most of us on this call are not going to need or hit just yet. And so it tells you what the auction date is and what the settlement date is. So let's say we want to buy this 3-month treasury bill. You would click this. Now, here's the rub, which sucks, but this is how it goes. Say I want to buy $5,000 worth, right? I would click 5 here, review order, right? And I would come up with this, and it would tell me the details of the order. Now, what it doesn't tell you is what the price of the 13-week T-bill is, right? It's not going to give you a price because it's an auction. You can expect to get around this yield, okay? But because it's technically an auction, they can't tell you exactly what price you're going to buy it at. You just know that you're going to be spending less than $5,000 because that's the value, that's the face value that you're going to be getting back. Sorry, that's the face value that you're going to be getting back, right? So you can expect a yield of around 5.1%. So you would calculate what is 5.1% less than $5,000, and that's what you would expect to pay around, okay? So you're going to buy 5 lots of the 13-week treasury bill. Again, this is the identifier, the CUSIP. The auction date is this. And then you would click place order. And if you click place order, you can cancel it. It will show up in pending. You can cancel it. But if you click place order, then on this auction date in the morning, it will execute this order. You will buy 5 lots of the 13-week treasury bill. Again, it's going to be less than 5,000, but 5,000 is what you're going to get back at maturity, which in this case is at the end of the 13 weeks. Okay. And remember, anything less than a year, you're not paid a coupon. You're just paid the face value back at maturity. And it shows you the maturity date, which is August 3rd, 2023. So any questions so far here before I go into a bond ladder? The return is annual for 3 months. I already said NH, it's annualized. Most of the brokers like Fidelity are giving 4+% on the cash balance. Yes, but look up the tax disadvantage of that, and also look up whether that is only subject to FDIC. Because if you have more than 250,000 and you're trying to park your cash somewhere, the safest place to do it is treasuries, not a bank. Any questions on this? Nice guitar, by the way, King Julian says. Yes, that is a Fender, a black Fender Strat. What model is it? I don't know. I'll show it to you after. Are the funds we used to buy T-bills in a brokerage account still available for margin in that account? Or it reduces the available margin? Obviously, it reduces the available margin. But I have multiple accounts. You can open up as many accounts as you want on TD. Like I have 1 million accounts on TD. I just got in. Apologize for the delay. How long do I have to keep the money in the treasury account? The whole time. Why would they pay you the interest if you took your money out? What's the point of having all those accounts for one platform? Because I mean, that's not the point of this lesson, but I guess it would help to answer. But because one is a margin account that I use for day trades, etc. And then I have an account that I use for treasuries, and then I have an account that I use for like a long-term portfolio, and then I have an account that I use for a more aggressive long-term portfolio. It's just, that's how I like to separate it. How do you sell when it matures? You don't. You just get credited. Every day you will see the balance in your account increase that you hold the treasury, and then in this case, by August 3rd, the full $5,000 will be in your account. I just answered this. Yes. Sonu, I just literally answered this. Yes, it will reduce if you're using the same account that you have to buy options and futures, it will reduce your margin. And what is the minimum time? Simona asks. The minimum time is whatever you choose. So do you want to buy a 13-week bill, a 4-week bill, a 26-week bill, etc.? You choose that. Here. And as they are available, you would pick which one you want. So, are you penalized if you sell the T-bill before maturity? You could be, yes, because the price of the T-bill can go down. If treasury yields go up, the price of T-bills go down. If treasury yields go down, the price of the T-bill goes up. So it depends. It's a market. As a T-bill note does not fluctuate, is it a suitable place to store your cash in your TD account? I feel like you guys are asking me questions that I'm already answering. You can get out of T-bills at any time. Yes, you could sell T-bills at any time, but you will not get the full amount at any time. Like what if you entered a 13-week T-bill and it has a yield of 5.1%, why would you expect to get this yield if you sold early? Right? You're not. Gonna get on Fidelity and buy some tomorrow. Amazing. Interesting stuff. I had no knowledge of treasuries before this meeting. Yeah, no worries. Okay, now a bond ladder is even more interesting. So in order to take advantage of different yields in different times, and in order to have more liquid cash, instead of saying, say, putting all your money in a six-month T-bill, like say you had, I don't know, $50,000, and instead of putting let's just call it $30,000 for simplicity. Instead of putting all your $30,000 in a 6-month T-bill, here's what you could do. You could put 10,000 in a 3-month, 10,000 in a 4-month, and 10,000 in a 6-month. And that way, once the 3-month is approaching maturity, you could take that and throw it back in a 6-month, right? And now you have the 4-month approaching maturity. You could take that and throw it back in a 6-month. And then once the original 6-month is hitting maturity, you could take that and throw it back in a 6-month, etc. So that way you have different treasuries expiring at different times or maturing at different times, and you aren't keeping all your money tied up for a lengthy amount of time, right? You could do this between the 1 month, 2 month, and 3 month. A lot of people do this between the 1 year, 2 year, and 3 year, etc. So as the first one comes up on maturity, once that matures, you could take that money and put it in a longer term. And now the next one is coming up to maturity. And then you could take that and put it in a longer term. And now the last one is coming up on maturity. You could take that and put it in a longer term. And that way, every year or every month, depending on how frequent you want to set it up, you can have bonds maturing and you can have more liquid cash available. So you don't auto roll. Not sure what that means, Susie. Is there a fee to buy? No. Unless you call up TD Ameritrade. This is the weird thing with TD. If you call them up and you talk to a fixed income specialist and you buy it that way, they will charge you a fee. If you do it this way, there is no fee. And if you do it on treasurydirect.gov, there is no fee. NH. Early exit will give us the prorated interest. Yes. What about taxes? It depends if you're doing this in a tax advantaged account or not. Also, different states have different tax rules. So you want to look that up, or talk to your accountant. But treasuries in most states, in my view, are better from a tax perspective than interest earned in, say, a bank account. Chona says, great info. Will follow the strategy. Yeah, appreciate you, Chona. What is the big difference between ZT and T-bills? Completely different. ZT are futures. We can go over that. I just bought I-bonds at 6.89% on Treasury Direct. Yeah, that was the last round of I-bonds. Those I-bonds were paying close to 10, Princess P. They dropped, as inflation continues to drop, those I-bonds will drop. And, they will eventually not be worth as much. And also I-bonds are limited to $10,000, whereas T-bills, you could buy hundreds of millions of dollars worth of T-bills. Susie says, Fidelity asks if you want to auto roll before purchasing. Yeah, you could do that. You could certainly do that. I mean, for me, I keep track of all my investments. So, I essentially, I don't auto roll. I just do it manually. Also, the funny thing with TD Ameritrade is you can't invest in bonds or treasuries on Thinkorswim. You have to do it on this site. But once you do it, it will show up. It will show up on your on your Thinkorswim platform, right? So I have I have a view of when these treasuries are expiring, and do it myself. I wish I had hundreds of millions to spend on T-bills. Clint, that's how rich people stay rich. Imagine you had $100 million and you just throw it into T-bills, right? And you're getting 5% on $100 million. That's wild, right? You're making $5 million risk-free. So that's how rich people stay rich. Z, this is amazing info on treasuries. I'll put ladder concept to work. Appreciate you, W Cloutet. Appreciate you. All right. So that is that is the bit on how to buy treasuries. Again, you could do all this on treasurydirect.gov. I prefer to do it on TD Ameritrade. Again, you can either invest in new issues or you can buy bonds that are already in the market. We went over how to read this in TD Ameritrade. You know, the yield to maturity, the price, et cetera, the minimum quantity to buy, the fact that each of these lots represents $1,000, the fact that over a year, you're going to get a coupon payment. Anything that's less than a year, you're not going to get a coupon payment. You'll just get the face value back. So hopefully all of this was helpful. Any last minute questions before we hop off? Could you please provide a link in this chat that gives us the details of the different types of treasuries we could buy? Just go to your broker or treasurydirect.gov. I can't give you a link to this. This is a TD Ameritrade. This is a page on my TD Ameritrade account. But in TD Ameritrade, you go to research and ideas, go to bond and CD wizard, and you will get to this page, and then click on new issues. Thank you guys so much for the feedback and the compliment. This was great. Thanks for everything. Appreciate you guys. Z, very helpful. Thank you. Assuming FOMC raises by 25 bips on May 3rd, would we get a better yield if we wait to buy T-bills until later in that week? It depends on what the bond market does. Just because the Fed raises by 25 bips doesn't mean that these will also go up. Remember, bonds are a market. So if that's expected, if nothing else comes with that, right, like no expectation of economic projections have changed, then you likely won't get a huge change in yield. So if it was the case that these yields go up every single time that the Fed raises rates, they just go up automatically, then it would be very easy to trade. But sometimes they go up, sometimes they go down, right? It's a market like anything else. So the Fed raises 25 basis points. It doesn't mean that all of these are raised by 25 basis points. It means that bond investors will react to what is released on FOMC based on what is released on FOMC, and they'll either buy more treasuries or sell more treasuries, depending on that. So just keep in mind that just because the Fed raises rates doesn't mean that all these are raised, right? It's a market. Mike says it's a market, so doing 5 bips is most likely priced in. Yeah. Thank you. Great session as always. Thank you guys for joining. Appreciate you guys. And those of you that aren't in the academy, you should get a link for a huge discount that you definitely want to take advantage of, because these are the types of calls that we do all the time. This isn't just a one-time thing. We just
I don't want to cut you off. I just got a question real quick.
We just opened this one up to the public, right? We do that usually like a couple times a year to give people a glimpse of what goes on. But yeah, this stuff, you know, we go over these calls multiple times a month. So
Hello?
yeah.
Oh, you can hear me?
Yes.
Okay. I just kind of like 2 questions. So I was watching one of your recent videos and you said that you were working in finance for quite a while. I just wanted to know, just curious about that, what you were doing in finance. And then also if that helped you with trading at all, or was it just a good thing to have on the side? And not how long it took you to become profitable, but the things like the work that you had to put in to get to that point. Because I know most of the time you could, you know, have all this time, but you're still not profitable just because you're not doing certain things that you should be doing. You get what I'm trying to say?
I think I captured most of what you're trying to say. So I majored in finance, and my goal eventually was to work on Wall Street. And then I went to law school, and I wanted to be, a corporate lawyer working on things such as mergers and acquisitions and whatnot. Finance school was not. I don't want to shit on it too much, right? But you definitely, just like anything in life, you learn more in the streets than you do in the classroom, right? So it was helpful in terms of knowing what are the drivers of macroeconomics and microeconomics, how money supply works, how to read financial statements, what are assets versus liabilities, why cash flow plays such an important role in a company's health, things of that nature. It does not help you at all with trading. Now I will give finance school credit for something, that when I'm reading headlines or digesting macroeconomics, or when I hear economists speak, it never sounded like a foreign language to me, right? Because I had that classroom training. So I will give it credit for that. That it does help you digest macroeconomics a lot better, and finance news a lot better, than someone who's coming in cold. Obviously, anyone can learn anything, right? But I will give it credit for that. It did not help with trading. Now it did help with identifying what derivatives were. Like before finance school, I didn't, I was aware of what options and futures were, but I wasn't aware of how these derivatives came about. What is the purpose? How they were traded, etc. So it does help with general knowledge, but yeah, it doesn't
like get you
show
really
you
go.
how to trade.
Yeah, I know what you mean.
That was completely learned out of school. In terms of what jobs I did, I worked as a financial analyst, and then I started training as a junior broker. Both jobs I absolutely hated. So I ended up working in tech through a long stream of circumstances. I dropped out of law school, ended up getting a job as a software engineer, and then ended up working in Silicon Valley. And then I enjoyed that a lot more, doing that and then trading on my own, than actually working in finance. So, and then in terms of how long it took to be profitable, 2 to 3 years, I started seeing consistent success. I have seen people in the academy do it in their first year, and I've seen people take 5 years. Everyone is tuned differently. Just like in, I don't know, just like in sports, there are people that can go to the league from high school. There are people that need 4 years of college. It's, everybody's different. Everybody's different.
Yeah, I know what you mean. Thank you.
Yeah.
I appreciate the stream also. It was informative, man. I liked it.
No worries. Appreciate your role. Thank you so much, Gorilla Trader, DK, Susie, Erica, Ophir, Ruben, Shafiq, Sonu. Thank you guys so much. Appreciate the kind words. Thank you so much. Imperator 99, Wallywood. What is your recommendation regarding buying bonds, T-bills? I mean, David, I just went over for 40 minutes on how to buy bonds and T-bills. I don't know what your question is, honestly. Will this webinar be recorded? Yes, it is recorded. Why do you prefer to buy them from TD versus the government? Just because all my accounts are in TD, so it's a lot easier for me to do that. Should we long or short T-bills? You cannot short T-bills. Warriors or Kings? I think the Warriors are pulled off, but the Kings look freaking dangerous. Appreciate you, Justin. Thank you guys so much for joining. Appreciate you guys. D Harvey, Dan Martin. Regarding those who work 9 to 5 but want to trade during the weekend, you can't trade during the weekend. Would you recommend trading ES during this time frame? You can't trade during the weekend. I mean, futures will open up, Sunday night, but it's going to be usually low volume. So, I would suggest, honestly, like I found a job where I was able to trade, and I'm on the West Coast. So I found a job where I was able to trade at my desk and also able to trade for a whole 3 hours before I started work. Right. So really if you really wanted to trade, day trade, you have to change your circumstances, right? Like I was working in software and I was working on the West Coast. So honestly, I had 4 hours to trade really, because I would get into work around 9:30, 10, and I started trading at 5:30, right? Because 5:30 West Coast time, because that's when the futures volumes start kicking up, and then I can trade options at 6:30. So yeah. What T-bills do you personally buy? I went over that as well. You could do a bond ladder, a T-bill ladder, 1 month, 2 month, 3 month, 3 month, 4 month, 6 month, 1 year, 2 year, 3 year, 3 month, 6 month, 1 year. It really depends on your time horizon and depends on how much yield you want to capture. It's all here. I can't tell you what to buy or what's good for you.
Can I ask you one more question on the tax situation? On the
Yeah,
T-
what's up, Marty?
um, the interest earned, does that come under capital gains?
If it's short term, yes.
So anything over a year would be the less percentage on capital gains, or
Exactly. Yeah.
okay, just checking.
Yeah. And also less, like, depending on what state you live in,
Yeah,
treasuries are tax advantage too. So
thanks.
David, we were trying to see what is good for you. What are you talking about, bro? What is good for me? I'm trying to capture as much yield as possible. In terms of long-term investments, I do have a lot of dividend stocks. I have long-term stocks that I've been collecting for, 15 years or so. But I am liking capturing the yields on the shorter term T-bills. So, I have T-bills expiring. I have more, not just a 3-pronged bond ladder, but I'll have 1 month, 2 month, 3 month, 4 month, and then just keep recycling that. If something changes and say like the 6 month pops in yield, then I'll start looking at that as well. But whatever liquidity that is good for you, and whatever yield is good for you, right? Some people can afford to lock up their money for a year, and that's what's comfortable for them, and they want to capture 4.8%, and so they put all their money in a 1-year T-bill. You could do that as well. Bond ladder, fuck the world. Gorilla Trader says. Appreciate you guys. Hopefully I answered all of your questions. I'm trying to see if I left one off. Is there a class on the Discord for trading view charting? We go over it. Yeah, I mean, there's the regular masterminds. Yes, not on the Discord, but just like this. Is the discount sent today? Yeah, you should see it in your email. If not, email subscriptions at thetravelingtrader.com. Dr. L, I asked you about Apple. What did you ask me about Apple? I can't guess your question.
Hi, sorry, that's me. Can I ask you now?
Yeah.
Okay, so last week you did a covered call on Apple. And I wanted to know why you didn't roll that to a next expiration monthly, or, why take a loss? I just want to know your
I didn't do a cover
perspective.
call. It was a credit call spread. And my max loss on that credit call spread was minus 25%. And I said, if we hit minus 25%, I'm going to jump out of that because earnings are coming up too. So I don't want to get my face ripped off if Apple completely crushes earnings and goes, well into the 170s. That credit call spread would be down 40, 50%. So it was a pre-earnings risky play that I took that was actually up about 15%. 15% wasn't enough profit for me, so I was willing to hold it, and minus 25 was my threshold. But it wasn't a cover call, no.
Would you not roll a spread?
I wasn't interested in rolling that spread. I was looking at establishing potentially a new position after earnings.
Oh, okay.
Yeah, because
Thank
earnings
you.
earnings are coming up on Thursday. Yeah, no problem.
Amazing.
Thursday or
Thank you.
Tuesday? I think Tuesday, actually.
Third, I think.
Let me see.
Thursday.
Thursday. Okay, there you go. In your academy, do you share live buy sell actions? Yes, we do. Z, first time caller, long time listener. Just wanted to thank you. Appreciate you, Zoom user. First year in the books for me, broke even, but I'm hoping to find consistency. I appreciate you and good luck, and you will.
Z, quick question. First time caller. By when will we get the recording of today's session approximately?
God, I should have checked with my team on this. I'm honestly like, if you're in the academy, you'll get it immediately.
Oh, I'm as I said, a first time caller. I wanted to join, so I just wanted to see approximately, will we get it today?
I honestly, you know what? Let me check, actually. 1 second.
Yeah, because I missed the first hour, so I'm sorry. This was very helpful.
Is the recording emailed out? Is it is it same day? Or is it tomorrow? Okay. All right. Thank you. All right. I'm still on the call. I'm gonna call you back. All right, that's fine. Sorry, just calling the ops manager. So I asked, when will it be sent out? And she said, as soon as you give it to me. So I have to give it. I'm gonna email it to her after this, and then you guys should get the email today, by today. All right. Cool. Any other last minute questions? We're coming up on 2.5 hours. We always go over, but I enjoy these. So it's never bothered to me. All right. Appreciate you guys. Thank you for joining. Have a good rest of the Sunday. I will see a lot of you tomorrow in the academy. Thank you guys so much. Appreciate the feedback. Appreciate your time. Appreciate you listening. Appreciate the questions and all these shenanigans. Thank you guys so much. Have a great Sunday, and I'll catch you guys soon. Peace.